Hey folks, welcome to a product review at Finominal. Today we're going to look at the First Trust Dorsey Wright Focus 5 ETF that trades under the ticker FV. Now, the ETF is effectively funds, and that's simply because it allocates to other ETFs of First Trust, and specifically sector and industry ETFs. And it allocates to these based on kind of relative strength methodology developed by Dorsey Wright. And so you can think of it kind of like a momentum-based strategy across industries and sectors that aims to outperform the stock market. So let's have a look in terms of if this ETF has achieved that. And we're going to kick off with a benchmarking exercise. Now, we do see that the suggested benchmark from the fund analyzer is the Russell 3000. If you do look at the fact sheet of the ETF, it does state the S&P 500, and you can use either index as a benchmark. They're very similar from a tracking error correlation R-square perspective. Having said that, if you do look at the performance of this First Trust Dorsey Wright Focus 5 ETF, which is a mouthful from a naming perspective, it actually has underperformed both indices since its inception in 2014. And as you can see, actual returns are kind of like all over the place, but so far that system in terms of selecting sector and industry ETFs, right, based on that relative strength algorithm hasn't been particularly helpful. Now, if you do look a little bit in terms of what's been driving the risk and returns of this portfolio, we do see that from an asset class perspective, it's just equities as expected. What's a little bit more interesting from a factor perspective, that we would expect this to have a kind of consistently positive exposure to the momentum factor. And indeed, we see that. So the exposure to momentum was most of the time positive. We also do see that there's consistently negative exposure to the low volatility factor, and the exposure to value and quality and size is kind of like all over the place. So basically, you're getting a portfolio of ETFs, and if you look at that through to the underlying portfolio of stocks, these tend to be outperforming stocks, but also ones that are very volatile. And that's, as mentioned, kind of expected with a kind of like momentum strategy. From an alpha perspective, we do see that over the last 11 years, this fund has only outperformed the S&P 500 in 3 out of 11 years, and only generated alpha in 2 out of 10 years, which is quite poor. What is attractive, the high active share of 100% compared to the S&P 500, so there's very little overlap. But of course, that would hopefully translate into outperformance and alpha. And if you look at the return contribution over time, you can see that almost all the returns are explained by the stock market, which is expected. But we would have hoped that that relative strength system that Dorsey Wright developed to identify sector and industry ETFs that are attractive would translate into positive alpha, which it has not. Now, this is for this ETF on a standalone basis. We should also compare it to peers. And what we've selected is effectively 3 ETFs and 1 mutual fund that all pursue momentum strategies in the US stock market. And these are products from iShares, Spider, EQR, and Alpha Architect. So first, it probably makes sense to look at those kind of like products from a factor perspective. And so we do have a look back of 9 years, which is meaningful. We do see that the beta to the stock market is consistently high. And we do see that positive exposure to the momentum factor for all products. So from that perspective, we can say these peers are meaningful. We do see that the First Trust Dorsey Wright Focus 5 ETF has had the second highest beta to the momentum factor, but there's actually one from Alpha Architect, QMOM, which has had a higher one. We do also see that there are other factor exposures that are either desirable or undesirable from your perspective. You can see that the positive exposure to value, negative exposure to low vol, as we saw earlier, slight exposure to the size factor. But overall, it seems that these peers are relevant. And then we can move on to performance. And so we do see the performance since, well, 2015, 2016. We do see that the product from First Wright, effectively, that it performed, well, kind of quite poorly compared to other 4 products. In fact, only the product from Spider performed worse. And while 3 other products performed better. And what's kind of interesting is that, especially the product from iShares, which is just well, kind of index tracker that tracks the US momentum index from MCI, that has consistently outperformed. We do also see the mutual fund from AQR, the large cap momentum one, also generated consistent outperformance to this First Trust Dorsey Wright product. Now that's from a pure return perspective, but we should also look at it from a risk perspective. And here we're going to have a quick look at the drawdowns during crisis periods. And it's a kind of divergent perspective. So we do see, for example, that in some periods, for example, here during the sell-off in 2022, the product from First Wright did slightly better than some of those other peers. But then in other crisis periods, for example, during COVID-19 in 2020, it did worse. 2016, it did worse. So there's no consistency here from a risk perspective. We also do see that historically, if we look at distribution of returns, there has been a bit of tail risk with that First Trust product, which simply can mean that you were allocated to a sector or industry ETF where you had a small crash, abrupt correction, something like that, where the trend broke and you weren't able to exit quickly enough. Now, if we kind of pull this picture together from a risk and return perspective, so we saw that the product from First Trust, Dorsey Wright, effectively has generated kind of like a relatively low return compared to those peers. It's also higher from risk perspective, and that of course translates into a relatively unattractive Sharpe ratio. Now, that's from a pure data perspective. The other point that's worth mentioning is that this product, the First Trust Dorsey Wright Focus 5 ETF, which should be renamed to something more eloquent, that it's actually quite expensive. So the other products charge somewhere between 15 and I think 40 basis points. And this product from First Trust charges 30 basis points. But given that it's a fund of fund, that means there are also underlying management fees that have to be paid to First Trust, and that's another 60 basis points. So the total management fee is 90 basis points, or the total expense is 90 basis points. And that kind of summarizes our perspective on this product, that effectively it's very expensive, and unless you look properly, right, most of the expenses are kind of like hidden or not easily seen. And then combined with a lack of performance and also not more attractive risk characteristics, simply highlights that this kind of relative strength system developed by Dorsey Wright hasn't been able to generate significant value over the last 9 years. And you likely are better off with simple momentum strategies that are also much more affordable. That concludes our analysis. Hope that helps. Have a nice day.